In this video, we are looking at three growth stocks. The S&P is down around 20% for the year, and in this difficult environment, the stocks must be chosen very carefully. So what do these three stocks have in common? First, they have a huge moat, so it's very difficult for competitors to break the moat. Secondly, they have solid fundamentals, healthy balance sheet, solid growth prospects, increasing profit margins. Thirdly, a lot of super investors that I follow buying or holding these stocks. And fourth, they are available at a discount according to my calculations or fair value. So let's look at these three stocks. So let's get started. First of all, if you have investment ideas or you want to make a deeper dive on any company, please write in the comments below. Okay, the first company that we're looking at is Visa, ticker V. The stock is down around 6% for the last year compared to S&P 500, which is down around 20%. It's from the financial services sector. Its market cap is $420 billion. If we look at some of their fundamentals, we can see that they have 18 billion in cash and 23 billion in debt. So they have net debt of 4.7 billion. They're paying a dividend. The dividend yield is 0.74%. Payout ratio around 18%, so less than 50% is something that I want to see in a dividend stock, so the dividend seems to be stable. They have both high return on assets and high return on invested capital. If we look at the growth prospects, we can see that analysts are expecting around 12% growth rate in the next year. We also can see that they have stable or even increasing margins, both gross margins and operating margins, so this is very important in high inflation environment. So this brings us to their valuation. So if we use discounted earnings per share method, if we take current earnings per share, grow them using the growth rate, which is around 15%, this is in line what analysts are projecting for the next 5 years, multiply by future price to earnings. I took trailing 12-month price to earnings and then discounted back today using the required rate of return of 10%. We get the fair value of around $250 per share, which implies that the stock is around 20% undervalued. So the stock is available at a discount, more than 20% undervalued according to this method. Okay, so we'll look at some of the numbers of Visa. So just like Visa, Microsoft has a huge moat. So once you start using the products of Microsoft, it's extremely unlikely that you will switch. So the switching costs are extremely high. It takes a lot of time to learn new products. If I look at their stock chart, we can see that the stock is down around 30% for the last year, which is worse than S&P 500, which is down around 20%. Its market cap is 1.7 trillion. If I look at some of the numbers, we can see that they have more cash than debt. This brings us their net debt to minus 30 billion. They are paying a dividend of around 1%. And have a relatively low payout ratio of around 29%. So again, just like for Visa, the dividend is not large, but seems to be stable. And again, just like for Visa, it has very high return on assets and return on invested capital. Analysts are expecting for the growth rate to be in the next year to be around 13%. And just like for Visa, Microsoft has increasing margins. So again, this is very important for high inflationary environment. So this brings us to their valuation. We do not want to overpay for the stock. And just like for Visa, we are using the same valuation method. And according to this method, the stock is around 16% undervalued. So the fair value of the stock is around $270 per share. By the way, we are using trailing 12-month price to earnings. And for the companies that we're looking at, the price to earnings, the average price to earnings, usually much higher. So if we see a better environment, the price to earnings will be much higher. So these calculations of fair value are on the low end, so they're conservative. I can make the case that the fair value is much higher if we use the average price to earnings. So again, these kind of calculations are on the conservative side. And again, according to these conservative calculations, the stock is around 16% undervalued. Okay, so we looked at Visa and Microsoft. The third company is Adobe. So just like Visa and Microsoft, Adobe has a huge moat. So if you use Photoshop or Illustrator, if you learn how to use these products, it's extremely time consuming to learn new products. So this is the source of their moat. The switching costs are extremely high. So if we look at the chart of Adobe, we can see that the stock is down around 40% for the last year. Its market cap is 155 billion. If we look at some of the numbers, we can see that they have more cash than debt. So they have net debt of minus 1.5 billion. They are not paying a dividend. And just like Visa and Microsoft, they have relatively high return on assets and return on invested capital. If we look at the growth prospects, we can see that analysts are expecting around 12% growth rate in the next year. And again, just like for Microsoft and Visa, if we look at their margins, we can see that they're increasing for the last years. So again, this is extremely important for high inflationary environment. And if we look at their valuation, we are using the same method that we used for Microsoft and Visa. This brings us their fair value of $395 per share, which implies that the stock is around 18% undervalued. So according to this method, the stock should trade closer to $400 per share. Okay, so we looked at three companies: Visa, Microsoft, and Adobe. So these three companies have a huge moat. It's very hard for competitors to break this moat. Mostly it's switching costs. They have solid fundamentals, healthy balance sheet. They have high gross margins and operating margins. In the high inflation environment, this is extremely important. Two of these three companies are paying a dividend. The dividend seems to be stable, and these stocks are available at a discount, around 20% undervalued. Also, if you want to know more about other purchases of super investors, here is the video. If you are not subscribed to the channel, you can do this by pressing the button right here. Thank you very much for watching till the end. Merry Christmas, Happy New Year, and see you in the next video.